and welcome back. You are listening to Passing the Baton. I'm Jared Hight from Tracktown Law, and today we're taking a deep dive into Oregon's $1 million estate tax threshold, why it catches far more families than you might think, the 5 bills moving through Salem that could raise or even erase that number, and the planning moves you can put in place right now while the law is still on the books. Quick disclaimer, I'm an Oregon licensed attorney, but this podcast provides general education, not personal legal advice. Always consult a qualified lawyer about your specific facts before acting. First, a quick primer. Oregon has levied some form of inheritance or estate tax since 1903, but the current structure dates to 2012, when lawmakers uncoupled from the federal system and froze our exemption at $1 million. Since then, the median Portland home has more than doubled in value, and the S&P 500 has tripled. A house purchased for $250,000 in 2000 can easily list for $750,000 today. At a traditional IRA worth $300,000 and a life insurance policy payable to the estate, and families who never felt wealthy can cross the threshold without noticing. Oregon's estate tax is progressive. The first dollar above $1 million is taxed at 10%. Rates climb to 16% on amounts over $9 million. The tax bill is due 9 months after death and must be paid in cash. The Department of Revenue will not accept a vintage truck or fractional ranch shares. For a $1.2 million estate, the taxable slice is $200,000, and the tax roughly pencils out to $20,000. That may not sound catastrophic until you realize heirs often need to liquidate investments or real estate quickly and sometimes at a discount to free the cash. If the estate owns a single illiquid asset, say a timber parcel worth $1.3 million, the heirs may be forced to log or sell at the worst possible time just to pay the tax. Couples often assume the marital deduction solves everything because assets pass outright to the surviving spouse tax-free. It does postpone the tax, but unlike the federal system, Oregon offers no portability. If the first spouse's exemption isn't captured with a credit shelter trust, that $1 million shield evaporates. The survivor now owns the entire estate plus future appreciation, but still only has the $1 million of exemption. Inflation alone can push the survivor's net worth past the cap even if nothing new is acquired. That's the current landscape, but it could change. The 2025 Legislature is debating 5 estate tax bills. Senate Bill 405 and its twin, Senate Bill 648, would tie Oregon's exemption to the federal basic exclusion amount, which is scheduled to fall to $13.61 million in 2026. If those bills pass, almost every middle-class estate would be removed from the tax entirely. House Bill 2058 would leapfrog slightly higher, hardwiring a $13.99 million exemption starting January 1, 2026, while also flattening the rate structure so the few taxable estates face one blended percentage rather than 7 brackets. House Bill 2301 splits the difference. It lifts the exemption to $7 million and replaces the sliding scale with a flat 7% rate on whatever value exceeds the cap. Sponsors say the idea is to give small business owners predictability while preserving some revenue. Senate Bill 124 doesn't set a number yet. It instructs the Revenue Committee to study options and deliver an inflation-indexed model that would bump the exemption annually the same way Oregon indexes its income tax brackets. Indexing would prevent future bracket creep even if lawmakers keep the $1 million base today. Each bill has passionate supporters. Farm groups argue that a higher exemption keeps family acreage intact rather than pieced off to pay tax. Small business coalitions say owners delay hiring or capital purchases because they must save liquidity for future estate tax. On the other side, education advocates warn that raising the exemption would cost the general fund roughly $150 million per biennium, squeezing the schools. Hearings have been spirited, and each measure still faces amendments. The 2025 legislature is scheduled to end on June 30th, and I'll record an update if one of these bills is voted out of both chambers or the legislature convenes without any change. Whether change comes this year or 5 years from now, proactive planning remains smart because even if lawmakers raise the limit, they may apply new rules only to future deaths. Documents you sign now can lock in flexibility no matter where the exemption lands. The cornerstone tool is the Credit Shelter Trust, sometimes called an A/B or bypass trust. When the first spouse dies, assets equal to that spouse's exemption, currently $1 million, fund the trust. The survivor can receive income for life, and, under a flexible health, education, maintenance, and support standard, can also access principal as needed. Future appreciation on those assets is forever outside both estates. The survivor keeps their own exemption, capturing $2 million of shelter even without portability. If the legislature later raises the exemption, the credit shelter language can be drafted to use whatever the state exemption is on the date of death, automatically taking full advantage of new limits. Life insurance ownership is another flashpoint. Policies you own are pulled into your taxable estate at full death benefit value. A $500,000 policy purchased to protect minor children can catapult a $900,000 estate over the line. Transferring ownership to an irrevocable life insurance trust removes the policy from taxation after a 3-year look-back. New policies bought by the trust skip the look-back entirely. Annual premiums can be covered using the $12,000 Oregon gift tax exclusion without dipping into lifetime exemption. Real estate needs careful titling. Oregon taxes non-residents on Oregon-sided property, but many other states do not reciprocate on property held in those states by Oregon residents. If you own Arizona Sunshine property, Arizona won't tax at death, but Oregon will. Placing the property into an LLC and systematically gifting minority units spreads value among heirs and freezes appreciation outside your estate while still letting you control management through voting units. Small business owners face special liquidity pressure. Oregon's natural resource credit can reduce estate tax by up to 15% if a farm, fishery, or timber holding passes to qualifying heirs who keep operations active for 5 years. Small business owners face special liquidity pressure. Oregon's natural resource credit can reduce estate tax by up to 15% if a farm, fishery, or timber holding passes to qualifying heirs who keep operations active for 5 years. Meeting the credit's multiple tests is paperwork heavy, so we build compliance binders, document hours worked by each heir, and calendar the annual revenue benchmarks. If the credit fails after 5 years, tax plus interest is due, so the binder creates an audit shield. Charitable planning remains versatile. A testamentary charitable bequest cuts the taxable estate dollar for dollar. A charitable remainder trust can move a low-basis rental into the trust, avoid immediate capital gains, pay lifetime income to the donor, and then parcel the rest to charity outside the estate. Donor-advised funds give a simpler option for smaller estates under the cap today that might cross it later. How do you know when to start planning? Inventory every taxable asset, home equity, retirement accounts, business interests, vehicles, collectibles, and life insurance proceeds payable to the state. Add a conservative appreciation factor, 5% for retirement assets, 3% for real property. If you sit at $800,000 today, your estate can hit $1 million in 5 years without any new acquisitions. Remember, estate tax lands on value at death after the step up in basis, so unrealized capital gain is irrelevant to the threshold. Couples often overlook jointly titled property. Joint tenancy does not have the value for estate tax purposes. Half stays in each estate unless a credit shelter trust retitles the first half. Blended families should pay special attention, because leaving everything outright to a second spouse can unintentionally disinherit the first spouse's children and double the tax if the survivor's family tree changes. What about moving to Washington or Nevada? Yes, some Oregonians change domicile to escape estate tax, but the Department of Revenue audits residency claims. You must truly relocate, register to vote, file non-resident Oregon returns, obtain an out-of-state driver's license, and spend more than half the year away. Retaining an Oregon home as your primary dwelling, or continuing to see Oregon doctors undermines the claim. For many, establishing a credit shelter trust and insurance trust inside Oregon is cleaner than uprooting friends and community for tax savings that smart planning can often offset. Legislative uncertainty shouldn't paralyze you. Estate planning can be drafted to float with future exemption numbers. We write formulas that fund trusts up to the maximum Oregon exemption in effect on the date of the first spouse's death. If lawmakers raise the threshold to $7 million, your documents automatically expand capacity. Ignoring the tax leads to hurried sales, probate delays, and penalty interest at 9% per year on unpaid balances. Attorneys' fees balloon when representatives must petition for installment agreements or sell property under time pressure. By contrast, drafting a credit shelter trust, titling assets properly, and funding life insurance trusts cost a fraction of 1% of estate value and last decades. Ready to see where your balance sheet lands against today's cap and stress test your plan against pending bills? Visit tracktownlaw.com and schedule a strategy session. We'll model your assets, lock in today's best tools, and build clauses that flex if lawmakers finally raise the exemption. Next episode explains why hiring a lawyer beats relying on do-it-yourself estate planning forms and how professional drafting prevents exactly the tax traps we've covered today.